Hello, this video is about the balance sheet and it also has some practice problems. Here I'm showing the balance sheet and the statement of retained earnings side by side. You can see that the ending balance of retained earnings is recorded on the balance sheet. So we calculated the ending balance in retained earnings as $6,040. And that is why we have to prepare the income statement first, because we need to know net income to create the statement of retained earnings. And then we use the ending balance on the retained earnings statement to create the dollar amount on the balance sheet for retained earnings. The balance sheet shows assets, liabilities, and stockholders' equity. Let's define each in more detail. What are assets? Assets are things of value, resources owned by the company as a result of a past transaction, and it will be used to create future revenue. So let's think about that. Things with a future value. For example, cash has a future value because it hasn't been spent yet. A restaurant's furniture has a future value because it will be used by customers in the future who will pay for their meals. Inventory is something that a company purchased with the intent to resell. In my example, I show designer handbags. Now, the company buys the handbags at one price and they're going to sell them to the end customer at a higher price. And that money should cover some of their profit, the salesperson's salary, any rent or utility costs along the way. If a company has extra cash, it may choose to purchase investments such as stocks or bonds in the open market. This is very rare and only affects companies that have a heavy cash balance, such as a Microsoft or an Apple or an Amazon. What is a liability? Simply put, liabilities are debt. They are any amount the company owes to a creditor. These are claims against the assets. For example, a company orders food for its restaurant. It calls up its supplier and orders food. The supplier delivers the food and then sends the company a bill to pay. The amount owed is a liability to the company and must be paid. Stockholders' equity, simply called net worth. It's the difference between what the company owns and what the company owes. So the things the company owns are assets, the things the company owes are liabilities, and the difference is stockholders' equity or net worth. The two major accounts here are common stock, the money paid in by the owners to start the company, and retained earnings. This brings us to the accounting equation. Assets equals liabilities plus stockholders' equity. Note that total assets in my example for Outdoors Company is $33,860. Total liabilities plus stockholders' equity is equal to the same amount, $33,860. Please note this is not a coincidence. This is why we call it the balance sheet, because the assets balance with a total of liabilities and stockholders' equity. The balance sheet reports assets and claims to assets, liabilities, stockholders' equity at a specific point in time. So remember, the income statement and the retained earnings statement covered a period in time. What were the sales for the month of July? The balance sheet says at the end of the month, in this example, July 31st, 2018, what was the balance in the cash account? And it was $13,300. It wasn't the average balance, it is the balance at the end of the month. Now let's talk about the order of the statements of the accounts in each category. Assets are a category, but the accounts under assets listed in my example are cash, accounts receivable, supplies, prepaid insurance, and equipment. And they are listed in a specific order. That order is called Order of Liquidity, and we'll talk more about that in Chapter 2. Let's look at the liabilities. The category is liabilities. The individual accounts include accounts payable, notes payable, salary and wages payable, and long-term notes payable. And there are others. This is just an example. Under common stock again, under stockholders' equity, we have common stock and retained earnings. Here are some common balance sheet accounts, and we've mentioned some of those already, and they are also in that order of liquidity for the assets. Note that cash is first, followed by accounts receivable, and note that land, building, and equipment are listed last. And the reason for that is because they have a longer life. Cash will be used much faster than a piece of equipment or a building. Liabilities are also listed in order of liquidity. Notes payable and accounts payable are on the top because they will be paid first. Long-term debt is on the bottom. Now you're going to see some balance sheets where notes payable is first, then accounts payable, or you'll see accounts payable first and then notes payable. It can vary. It depends specifically on the situation and which one is due first. Here's a quick look at the statement of cash flows, and while you are not responsible to know how to prepare it, it is interesting to note that there are 3 sections in it: cash from operations, cash from investing, and cash from financing. And those are the 3 major business activities. So let's look under cash from investing. Cash from investing is a negative $27,500, and that means the company invested a net of $27,500 in the month of July. And you can see the big purchase was a 12-passenger van for $30,000. They also had a positive cash inflow. They sold some canoes. So the cash flow answers questions such as, where did the money come from? How was the money used? And what was the change in the cash balance during the period? And note that the cash at the end of the period, $13,300, is the same as the cash listed on the balance sheet. The income statement, the statement of retained earnings, and the cash flow are for a period of time. The balance sheet is for a point in time. Let's practice. Which financial statements are for a period of time? You can pause the video if you want, or go to the next slide with a solution. Income statement and the retained earnings statement. Which financial statements are for a specific date, a point in time? The balance sheet. Let's practice the accounting equation. If you know assets are $25,000 and you know liabilities are $22,000, what is stockholders' equity? Assets have to equal liabilities plus stockholders' equity. So stockholders' equity must be $3,000. All right, let's do a longer problem. Using the outdoor company as an example, pause the video, get out a piece of scratch paper, and prepare the balance sheet for the Acct Corporation. Retained earnings is provided here at $5,000, but you could have just referred back to the Act's retained earnings statement for the balance also that was prepared in the previous video. And here is the solution. Acct Corporation name, line 1 is always the company name, line 2 is always the name of the statement, and line 3 is the date. And remember, balance sheet is an as of date and not a for the month ending, for the year ending, or for the period ending date. As of 12/31. Note that there are 2 asset accounts. Cash is first, then accounts receivable for a total of $89,000. Liabilities and stockholders' equity are next, and they also add up to $89,000. This is the end of this video on the balance sheet.